This one thought pattern is keeping you stuck in losses. There's a moment every trader knows. You're in a trade, it's going against you, and instead of closing it, you just sit there, watching, waiting, hoping. And somewhere in the back of your mind, a quiet voice whispers, "It'll come back." That voice, that one little thought, that is the thing that has cost traders more money than any bad strategy, any volatile market, any economic crash in history. Not the market, not bad luck, not your broker. That thought. And what makes it so dangerous, what makes it so incredibly hard to escape, is that it sounds completely reasonable. It sounds like patience. It sounds like discipline. It sounds like what a calm, experienced trader would say. But it isn't. It's a cognitive trap, a deeply embedded psychological pattern that your brain has been running since long before you ever placed your first trade. And until you understand exactly how it works, not just on the surface, but at the neurological, behavioral, emotional level, you will keep falling into it every single time. Today, we're going to break it down, all of it. We're going to look at the exact thought pattern that keeps traders stuck in losing positions longer than they should be. We're going to trace it back to its psychological roots. We're going to show you the 6 distinct ways it shows up in your trading. And most importantly, we're going to show you what to do about it. Because this isn't just about losing money. This is about understanding yourself at a level that most people never reach. Let's get into it. Section 1. The pattern has a name, and you've been living inside it. Before we talk about trading, I need you to think about something completely different. I need you to think about a relationship. Not necessarily yours. Maybe someone you know. Maybe someone you've watched from the outside, shaking your head wondering, why are they still there? Why are they still in something that is clearly hurting them? Why do they keep defending it? Why do they keep believing that tomorrow will be different when every yesterday has been exactly the same? You've seen it. Most of us have. And from the outside, the answer seems obvious. Leave. It's not working. The evidence is right there. But from the inside, from inside that experience, it feels completely different. It feels like loyalty. It feels like faith. It feels like you'd be giving up too soon if you walked away now. Now, bring that same dynamic to your trading screen. You enter a trade, you have a thesis. The market moves against you. And instead of treating it like a business decision, instead of honoring your stop loss and moving on, something shifts. The trade stops being a trade. It becomes personal. It becomes a statement about whether you were right. And suddenly, you're not managing risk anymore. You're defending a position. Psychologists call this loss aversion anchoring, the combination of 2 well-documented cognitive biases that, when they merge inside a trading context, create one of the most destructive mental loops a human being can experience. The first part, loss aversion, was documented by Daniel Kahneman and Amos Tversky in their landmark research on prospect theory. Their finding was simple and stunning. The emotional pain of losing something is approximately twice as powerful as the pleasure of gaining the same amount. Let me say that again because it matters enormously. Losing $100 hurts about twice as much as winning $100 feels good, which means your brain, your perfectly functioning, highly evolved human brain, is wired to do almost anything to avoid locking in a loss, even when locking it in would be the logical, strategic, rational thing to do. And the second part, anchoring, refers to your mind's tendency to fixate on a specific number as a reference point and make all subsequent decisions relative to that number. In trading, that anchor is your entry price. The moment you enter a trade, that price becomes psychologically significant in a way that has nothing to do with the market. The market doesn't care where you got in. The price action doesn't slow down because you need it to come back to your entry. The trend doesn't reverse out of respect for your position size. But your brain? Your brain treats that entry price like a sacred threshold, like the universe owes you a return to that number. And when the trade moves against you, it doesn't feel like new information. It feels like a temporary injustice that will eventually be corrected. It'll come back. That is loss aversion and anchoring working together in perfect, devastating harmony. And here's what makes it even more insidious. The longer you stay in the losing trade, the more emotional investments you accumulate. Your brain starts to do something called the sunk cost calculation. It looks at everything you've already endured, the stress, the waiting, the hope, the watching, and it whispers, "You can't give up now. You've already been through so much. It would be a waste." As if the suffering you've already experienced is a reason to keep suffering. As if the time you've already lost is a reason to lose more time. As if the money you've already dropped is somehow saved by staying in longer. It is not logical, but it is profoundly human. And the fact that it is profoundly human is exactly why it is so hard to override. Now, here's where it gets really interesting. This pattern, this combination of loss aversion, anchoring, and sunk cost thinking, it didn't develop because of trading. It developed over hundreds of thousands of years of human evolution, in environments where resources were scarce, and giving up on something could mean starvation. The brain that refused to quit had a survival advantage. The stubborn brain survived. But the markets are not a survival environment. The markets are a probabilistic environment, and the cognitive hardware that kept your ancestors alive is actively working against your account balance. You are not broken. You are not weak. You are not disciplined. You are running ancient software in a modern context, and until you see that clearly, you cannot begin to override it. Section 2. The pattern has a name, and you've been living inside it. Here's something I want you to sit with for a moment. The pattern we're describing, this refusal to accept a loss, this hoping and waiting and rationalizing, it doesn't look the same in every trader. It's not a single behavior. It's a root cause that expresses itself in 6 distinct ways. And depending on your personality, your background, your emotional wiring, you may recognize one of these immediately, or maybe you'll recognize all 6. The first face is the rationalizer. The rationalizer is sophisticated. The rationalizer is smart. And that's exactly the problem. When the trade goes against them, they don't panic. They think. They pull up more charts. They find new indicators that suddenly support their original thesis. They zoom out to a higher time frame where the trade still looks good. They read analysis from other people who happen to agree with their position. They construct an elaborate intellectual framework for why staying in is the right decision. And every single piece of analysis they do is backward. It starts with the conclusion, I need this trade to work, and works backward to find the evidence. Psychologists call this confirmation bias, and in the trading world, it is dressed up as research. It looks like due diligence. It feels like being informed, but it is just hope with a spreadsheet. The rationalizer rarely admits they are rationalizing because they genuinely believe they are thinking. They are intelligent people who don't realize that their intelligence has been hijacked by their emotional state, because the most dangerous thing a smart person can do is build a convincing case for the wrong decision. The second face is the freezer. The freezer doesn't rationalize. The freezer just stops. When the trade goes against them, they go quiet. They minimize the window. They check the price every 30 seconds, but can't bring themselves to click the exit button. They know they should close it. Part of them can see it clearly, but they can't move. It's a phenomenon called decision paralysis, and it happens when the emotional cost of making a decision feels higher than the emotional cost of not making a decision. Closing the trade means crystallizing the loss. It makes it real. It makes it final. But as long as you don't close it, the loss is still theoretical, still floating, still possible to reverse. The freezer lives in that space between knowing and doing, and the longer they stay there, the worse the trade gets, and the harder it becomes to close, because now the loss is even bigger, and closing an even bigger loss feels even more impossible. It's a loop, and the exit from the loop only gets smaller as time passes. The third face is the averaging down addict. This is one of the most common and most financially lethal expressions of the pattern. The trade goes against you, so you buy more. The logic sounds almost respectable. I liked it at this price, so I love it at a lower price. I'm lowering my average cost basis. And in some specific contexts with specific assets, with specific position sizing rules, scaling in can be a legitimate strategy. But for most retail traders, averaging down isn't a strategy. It's a psychological defense mechanism disguised as one. It's a way of not accepting that the initial decision was wrong by making the position even
bigger, because if the price ever does recover, you'll not only break even, you'll profit. The problem is the if. Averaging down converts a limited loss into an unlimited one. It takes a manageable situation and transforms it into a portfolio-threatening event. And it is driven entirely by the need to not be wrong, not by any rational assessment of whether the trade is still valid. The averaging down addict is betting bigger at exactly the moment the evidence suggests they should be betting less. The fourth face is the justifier by time frame. You entered a swing trade, it went against you, so now it's an investment. You entered a day trade, it went against you, so now it's a swing trade. You entered a short-term position with a clear thesis. The thesis was invalidated, so now you're holding long-term because you tell yourself the fundamentals are strong. This is a defense mechanism so common it's almost a trading cliché, and yet it keeps happening. Millions of traders do this every day. They retroactively change the nature of their trade after it's gone wrong because changing the category of the trade feels better than accepting a loss. It's the same energy as the Rationalizer, but it operates on a structural level rather than a thesis level. The justifier by time frame isn't looking for new evidence. They're building a new container for the same broken position. And what makes this particularly damaging is that it ties up capital. Money that's locked in a position that was supposed to be closed out last week or last month is money that can't be deployed in better opportunities. You're not just losing on the bad trade, you're losing the opportunity cost of all the good trades you couldn't take because your capital was hostage to your pride. The fifth face is the delegator to the universe. This one is quieter, more internal, and in some ways the most emotionally complex of all. The delegator to the universe reaches a point where they stop trying to analyze the trade, stop looking for new confirmations, stop calculating new targets. They just wait. They put their faith in something, the market, the charts, their original instinct, fate itself, and they wait for vindication. There's a kind of surrender in it, but it's not healthy surrender. It's not the surrender of acceptance, it's the surrender of avoidance. If it's meant to work, it'll work. I'll just give it more time. I've held this long, what's another week? This kind of passive holding can persist for months, for years, and it has a specific emotional texture, a low-grade anxiety that becomes so normalized you stop noticing it. The trade becomes background noise, a constant weight you've learned to carry, and meanwhile, the portfolio deteriorates quietly beneath the surface. The sixth face, and perhaps the most important, is the identity-fused trader. This is the trader for whom being wrong about a trade doesn't feel like a data point. It feels like a verdict. For the identity-fused trader, every trade carries a deep psychological load. Winning confirms they belong in the markets. They have what it takes. They are smart enough, disciplined enough, worthy enough. Losing threatens all of those things. A losing trade isn't just a losing trade, it's evidence against the self.
And so closing a losing trade becomes existentially terrifying because it doesn't just mean losing money, it means being wrong. It means failing. And somewhere in their psychology, failing at trading connects to something much deeper, to a fear of inadequacy, to childhood messages about competence, to a need to prove something to themselves or to someone else. These traders hold losses the longest. They fight the market the hardest. They suffer the most. Not because they are bad traders, but because they've made trading about who they are, and that is a weight no trade can bear. Does one of these 6 faces look familiar? Does more than one? Because here's what I want you to understand. Recognizing your face, seeing clearly how this pattern expresses itself in you specifically, that is the beginning of the end of the pattern's power over you. You cannot fight what you cannot see. Section 3. What's actually happening in your brain when you won't let go? Let's go deeper, because understanding the behavior is one thing. Understanding the neuroscience behind it, the actual physical processes happening inside your brain in real time, is something else entirely. And I think when you see this, something will shift. When you enter a losing trade and refuse to close it, your brain is not operating in its rational executive function mode. The prefrontal cortex, the part of your brain responsible for logic, planning, long-term thinking, and disciplined decision-making, is not running the show. The amygdala is. The amygdala is your brain's alarm system. It's primitive, it's fast, and it treats financial loss the same way it treats physical threat. When you're sitting in a losing trade, watching your account decline, the amygdala fires, and it triggers what neuroscientists call the fight or flight response. Now here's the critical part. In a genuine survival situation, fight or flight is brilliant. It shuts down non-essential functions, floods your system with adrenaline and cortisol, and prepares you to either attack the threat or run from it. But in a trading context, running from the threat would mean closing the trade, accepting the loss, moving on. But that's not what happens, because here's what the amygdala also does. It narrows your perception. It makes you hyper-focus on the immediate threat, the red number on your screen, and it impairs your ability to think abstractly about the future. It makes the emotional reality of right now feel more vivid, more significant, more real than the rational projection of what will happen if you stay in this trade for another hour, another day, another week. The scientific term for this is present bias, the brain's tendency to overvalue immediate emotional experience at the expense of future outcomes. Under stress, under the cortisol flood of a losing trade, the future doesn't feel real. The plan doesn't feel real. The risk management rules you wrote down in your trading journal don't feel real. The only thing that feels real is the trade, right now, the pain of closing it, the hope that it might recover, the desperate arithmetic of break even. And then there's something called neural pathway reinforcement, which is the process by which your brain literally rewires itself based on repeated behaviors. Every time you avoid the discomfort of closing a trade, every time you hold instead of execute, every time you override your stop, you strengthen the neural pathway that leads to avoidance. You are training yourself at the biological level to repeat the pattern next time. This is why traders who struggle with cutting losses don't usually get better over time just by experience alone. Experience, by itself, without conscious intervention, often makes the pattern stronger, not weaker. Because the experience without reflection just adds more loops to the same highway in your brain. There's also a role of dopamine here that most people don't talk about. When you enter a trade, your brain releases a small amount of dopamine, the neurotransmitter associated with anticipation and reward. This is why trading can feel addictive. The entry itself is exciting. The possibility is exciting. When the trade goes against you, dopamine drops, and your brain, which is deeply motivated to restore that dopamine level, starts looking for reasons to believe the trade will recover because the possibility of recovery produces a small dopamine response, just enough to feel like hope. So your brain is literally rewarding you for staying in bad trades, not for the good outcome, for the mere possibility of a good outcome. You are being biochemically encouraged to hold, to wait, to hope. And fighting biochemistry with willpower alone is like trying to stop a river with your hands. This is why rule-based systems matter so much. This is why mechanical stops that execute automatically before you have a chance to override them, are not just tactical tools. They are cognitive prosthetics. They are external structures designed to compensate for the exact moment your internal hardware breaks down, which it will, every time, because you are human. Section 4. The moment of truth. What it actually feels like to override the pattern. I want to tell you something that doesn't get talked about enough. Cutting a loss feels terrible, not just a little uncomfortable, not just slightly unpleasant. It feels terrible in the moment, with your finger on the button, watching the price, knowing what you're about to do. It feels like failure. It feels like surrender. It feels like you're doing something wrong. And I think one of the most harmful lies in the trading education space is the idea that if you just understand the psychology well enough, cutting losses will eventually feel easy, that one day, with enough experience and enough wisdom, you'll exit bad trades with the serene detachment of a Zen master. That's not how it works. The traders who manage risk consistently, the ones who protect their accounts, who keep their losses small, who live to trade another day, they don't do it because it feels easy. They do it because they've built a relationship with the discomfort. They've learned to act in spite of the feeling, not in the absence of it. That distinction is everything. There's a concept in acceptance and commitment therapy, ACT, developed by psychologist Stephen Hayes. The concept is called diffusion. Diffusion is the practice of creating psychological distance between yourself and your thoughts. Instead of thinking, it'll come back, and immediately treating that thought as truth, you learn to observe it. You learn to say, I notice I'm having the thought that it'll come back. Tiny shifts in language create space, and in that space, you have a choice. Not between feeling comfortable and feeling uncomfortable, that choice isn't available, but between acting on the feeling or acting on your plan. Those are different things. The traders who master this don't stop feeling the pull to hold. They feel it clearly, fully, and they close the trade anyway. And then something interesting happens. The next time the pattern shows up, they remember. They remember that the discomfort of closing was temporary, that within minutes or hours, the anxiety dissolved, that their account was intact, that they were free to look for the next opportunity. They build what psychologists call emotional memory, a recorded experience of the fact that the feeling of cutting the loss was survivable, more than survivable, liberating. And slowly, not overnight, not after one good trade, but slowly, the fear of the exit begins to shrink. Not because the exit stops feeling hard, but because your brain now has evidence that you can do hard things and that the hard thing was worth doing. This is how the pattern breaks. Not through a single moment of enlightenment, through repetition. Through consistent behavior that builds a new neural pathway alongside the old one that says, I act according to my plan, even when it hurts. Section 5, the identity shift that changes everything. We need to talk about who you think you are as a trader, because I've found, and the research supports this, that behavior change in trading is almost impossible until it's preceded by identity change. Think about what it means to say, I am a trader who cuts losses quickly. Not, I try to cut losses quickly. Not, I'm working on cutting losses quickly. Not, I know I should cut losses quickly. But, I am a trader who cuts losses quickly. That statement, when you genuinely internalize it, changes everything. Because when your identity is aligned with the behavior becomes the natural expression of who you are. And when you act against it, it creates cognitive dissonance, a psychological discomfort that actually motivates you back into alignment. The problem is that most traders have unconsciously adopted a different identity.
They have become, without choosing it consciously, a trader who defends positions, a trader who waits for validation, a trader who needs the market to confirm they were right. And all of the knowledge in the world about psychology and bias and neuroscience won't change the behavior, because behavior flows from identity. And until the identity changes, the behavior can't. So how do you change your trading identity? Not by telling yourself different stories, that rarely works. You change it through action. Every time you honor your stop, every time you close the trade that needs to be closed, you cast a vote for the trader you want to become. James Clear articulated this brilliantly in Atomic Habits. Every action you take is a vote for or against a particular identity. One vote doesn't win the election, but 50 votes, 100 votes, 1,000 small, consistent acts of discipline, those rewrite the story you tell about yourself. And the story you tell about yourself is the single most powerful variable in your trading psychology. If you believe, at a deep level, that you are the kind of trader who manages risk well, your brain will create discomfort when you violate that. It will flag the open losing position. It will nudge you toward the exit. It will make staying in feel wrong. But if you believe, at a deep level, that you are the kind of trader who always needs one more chance, one more candle, one more day, your brain will create justifications. It will find the analysis that supports your hope. It will minimize the evidence against your position. It will make staying in feel like wisdom. You get the trading you believe you deserve. Which trading identity are you currently voting for? Section 6. The practical architecture. How to build a system that overrides the pattern. Let's get concrete, because everything we've discussed so far is foundational, but without practical structure, knowledge stays knowledge and never becomes execution, and execution is the only thing that matters. There are 5 pillars to what I call the pattern override architecture, a personal system designed to intercept the thought pattern before it can take hold and redirect you toward disciplined, consistent action. Pillar 1, the pre-trade contract. Before you enter any trade, you must know 3 things: your entry, your target, and your stop. Not approximately, not roughly, exactly. And you must write them down, physically or digitally, but externalized, outside your head. The act of writing creates commitment. It makes the decision feel more real and more binding, and it means that when the trade goes against you, and your amygdala ires and your brain starts rationalizing, you have a document, a pre-trade version of yourself who was thinking clearly, to refer back to. The question you ask yourself when you're tempted to hold a losing trade is not, should I stay in? The question is, would I enter this trade right now at this price with this evidence? If the answer is no, you exit without negotiation, because the position you're holding is not the position you entered. Everything has changed except your attachment to the entry price. Pillar 2, the physical stop loss, non-negotiable. If your trading platform allows automatic stop losses, use them, always, without exception. I know some traders resist this because they feel they need flexibility, because sometimes the market wicks through the stop before continuing in their direction, because they have a more nuanced view of where the trade is invalidated. Those are legitimate conversations, and your stop placement can reflect that nuance. But the stop must be placed, and it must be honored. A stop loss is not a sign of doubt in your trade. It is a declaration of respect for your capital. It is the acknowledgement that you are operating in a probabilistic environment where no outcome is guaranteed, and that protecting your resources is more important than being right. The traders who survive long enough to become consistently profitable almost universally share one characteristic. They protect their downside obsessively, not their upside, their downside. Because you can always find another trade. You cannot recover from an account that's been blown. Pillar 3. The post-trade audit. After every trade, win or lose, you do a brief review, not to celebrate or mourn, to learn. Specifically, you ask 4 questions. Did I follow my plan? Did I exit when my criteria were met, whether that was the stop or the target? Did I experience any of the 6 phases of the pattern: the rationalizing, the freezing, the averaging down, the time frame shifting, the passive waiting, or the identity fusion? And what will I do differently next time? The audit is not about judging yourself, it's about collecting data. Traders talk constantly about the importance of data in the market. They look at price history, they study patterns, they analyze indicators, but they rarely apply that same data-driven rigor to their own behavior. Your trading psychology is a pattern. Patterns can be tracked, and patterns that are tracked can be changed. Pillar 4, the emotional check-in. Before you enter any trade, especially when you're on a losing streak or coming off a frustrating session, you do a 60-second internal audit. You ask, am I trading from a clear, neutral state, or am I trading to recover losses, to prove something, to feel something, to escape something? This single practice, 60 seconds of honest self-assessment, has the potential to eliminate a significant portion of your worst trades. Because the worst trades are rarely made from clarity. They are made from desperation, from revenge, from boredom, from ego. And once you can see those states clearly, you have a choice that you didn't have before. You can choose not to enter. Pillar 5, the identity statement. Every morning before your first trade, you read one sentence. I am a trader who follows my plan, takes my stops, and trusts the process. It sounds simple. It sounds almost too simple. But the research on positive identity reinforcement, on the relationship between verbal self-affirmation and subsequent behavior, is compelling. What you say about yourself consistently shapes what you believe about yourself, and what you believe about yourself shapes what you do. This isn't wishful thinking. This is deliberate identity engineering. You are building the trader you want to be, one statement at a time. Section 7. The deeper truth behind the pattern. Before we close, I want to say something that goes beyond the technical and into the profoundly human. The pattern we've been talking about, the refusal to accept a loss, the hope for recovery, the waiting and rationalizing and holding, it is not fundamentally about trading. It is about the human relationship with loss itself. We live in a culture that treats losing as shameful, that equates failure with inadequacy, that celebrates the winner and quietly ignores the lessons of the one who didn't win. We are taught from a very early age that being wrong is something to be avoided, not because of the practical consequences, but because of what it says about us. And so we carry that conditioning into everything we do, into our relationships, into our careers, into our trades. The trader who can't close a losing position is not weak. They are human. They are running the same psychological programming that billions of other humans are running. The one that says, accepting this loss means admitting I was wrong, and being wrong means something terrible about who I am. But here's what the most self-aware, consistently profitable traders eventually understand. Loss is not the opposite of success in trading. Loss is part of the process of success.
Every great trader loses. Not occasionally, regularly, systematically. They budget for losses the way a business budgets for operating expenses. They know that a certain percentage of their trades will not work, and that this is not a failure of skill or judgment. It is the statistical reality of operating in a probabilistic environment. The difference between the trader who grows and the trader who implodes is not the number of losses. It is the size of them. The trader who takes small, defined, planned losses and keeps them small, that trader survives. That trader compounds. That trader, over time, with a positive expectancy system, grows. The trader who avoids small losses and turns them into catastrophic ones, that trader does not survive. No matter how good their strategy is, no matter how smart they are, no matter how much they know about the markets. The loss is not the enemy. The thought pattern that makes the loss unspeakable, that is the enemy. And now, having watched this to this point, you have something most traders never acquire: a clear, specific, psychologically grounded understanding of exactly what that pattern is, how it works, and how to begin dismantling it. Section 8. a story before we close. There's a trader. Let me call him Marcus. Marcus came to trading after 15 years in corporate finance. He was analytical. He understood markets. He'd spent a decade and a half running financial models for other people's money, and he was ready to run his own. His first year was cautious. He kept his positions small. He took his stops. He was disciplined. Then he had a run of wins, and the wins built confidence. And confidence, without careful management, has a way of becoming something else. He entered a position on a commodity play. Solid thesis, good entry, reasonable stop. The trade moved against him almost immediately, and Marcus, brilliant, experienced, financially sophisticated Marcus, did not close it. He told himself the setup was still valid on the weekly chart. He told himself the fundamental story hadn't changed. He told himself he had a high conviction and the market was wrong. He averaged down twice. By the time he finally exited, 6 weeks after his original stop should have been hit, he had lost 40% of his trading account in a single position. 40%. Not because his original thesis was terrible, not because he wasn't intelligent, not because he didn't understand risk management in theory, because in the moment of truth, the pattern was louder than the plan. Marcus didn't quit trading, but he stepped back. He spent 3 months not trading at all, just studying, not charts, not strategies, himself. His psychological architecture, the exact 6 faces we described today. He learned where he lived in that taxonomy, and he built systems to intercept the pattern before it could run. And when he came back, he was different. Not because the market was easier, not because the pattern disappeared, but because he could see it coming. And seeing it coming, that single shift, gave him back his choices. He went on to build a system that had a win rate under 50%. He lost on slightly more trades than he won. And he grew his account consistently for 3 years running. Because the wins were bigger than the losses. Because the losses were small. Because he finally stopped letting a thought pattern make his decisions. Closing. The one thing I need you to take from this. If you've watched this far, and I know this has been a deep one, I want to leave you with just one thing. Not a technique, not a tool, one understanding. The market does not owe you a return to your entry price. The market does not know where you got in. It does not care about your stop loss. It has no awareness of your account balance, your financial goals, your stress levels, your family obligations, or your trading history. The market is not a judge of your worth. It is not confirming or denying your value as a person when it moves against your position. It is just price, moving according to its own logic. And the only question that matters, the only question that should drive your decision when you're sitting in a losing trade is this. If I had no position right now and I looked at this chart with fresh eyes, would I enter this trade at this price in this direction with this evidence? If yes, stay in with conviction, with a defined stop. If no, you have your answer, and the only thing left is to act on it. That's the whole game, in one question. The thought pattern that keeps you stuck wants to make it complicated. It wants analysis and justification and hope and more time. It wants to tell you that this situation is special, that the rules don't apply here, that just this once, a little more patience is wisdom. It isn't. The rules always apply, especially when the pattern tells you they don't. So now, having watched this to this point, you have something most traders never acquire, a clear, specific, psychologically grounded understanding of exactly what that pattern is, how it works, and how to begin dismantling it. And now, I have something to ask you. If you've watched this far, and I know this has been a deep one, I want to leave you with just one thing. Not a technique, not a tool, one understanding. The market does not owe you a return to your entry price. The market does not know where you got in. It does not care about your stop loss. It has no awareness of your account balance, your financial goals, your stress levels, your family obligations, or your trading history. The market is not a judge of your worth. It is not confirming or denying your value as a person when it moves against your position. It is just price, moving, according to its own logic. And the only question that matters, the only question that should drive your decision when you're sitting in a losing trade is this. If I had no position right now and I looked at this chart with fresh eyes, would I enter this trade at this price in this direction with this evidence? If yes, stay in with conviction, with a defined stop. If no, you have your answer, and the only thing left is to act on it. That's the whole game, in one question. The thought pattern that keeps you stuck wants to make it complicated. It wants analysis and justification and hope and more time. It wants to tell you that this situation is special, that the rules don't apply here, that just this once, a little more patience is wisdom. It isn't. The rules always apply, especially when the pattern tells you they don't. So now, having watched this to this point, you have something most traders never acquire, a clear, specific, psychologically grounded understanding of exactly what that pattern is, how it works, and how to begin dismantling it. And now, I have something to ask you. If you've watched this far, and I know this has been a deep one, I want to leave you with just one thing. Not a technique, not a tool, one understanding. The market does not owe you a return to your entry price. The market does not know where you got in. It does not care about your stop loss. It has no awareness of your account balance, your financial goals, your stress levels, your family obligations, or your trading history. The market is not a judge of your worth. It is not confirming or denying your value as a person when it moves against your position. It is just price, moving, according to its own logic. And the only question that matters, the only question that should drive your decision when you're sitting in a losing trade is this. If I had no position right now and I looked at this chart with fresh eyes, would I enter this trade at this price in this direction with this evidence? If yes, stay in with conviction, with a defined stop. If no, you have your answer, and the only thing left is to act on it. That's the whole game, in one question. The thought pattern that keeps you stuck wants to make it complicated. It wants analysis and justification and hope and more time. It wants to tell you that this situation is special, that the rules don't apply here, that just this once, a little more patience is wisdom. It isn't. The rules always apply, especially when the pattern tells you they don't. So now, having watched this to this point, you have something most traders never acquire, a clear, specific, psychologically grounded understanding of exactly what that pattern is, how it works, and how to begin dismantling it. And now, I have something to ask you. If you've watched this far, and I know this has been a deep one, I want to leave you with just one thing. Not a technique, not a tool, one understanding. The market does not owe you a return to your entry price. The market does not know where you got in. It does not care about your stop loss. It has no awareness of your account balance, your financial goals, your stress levels, your family obligations, or your trading history. The market is not a judge of your worth. It is not confirming or denying your value as a person when it moves against your position. It is just price, moving, according to its own logic. And You've just spent over 30 minutes with one of the deepest psychological explorations of trading behavior that exists in this space. That means something. Not everyone is willing to go here. Not everyone is willing to look at their own patterns with this kind of honesty. The fact that you watched this entire video tells me something about you. It tells me you're not looking for a hot tip or a magic indicator. You're looking for the real thing, the deep work, the actual reason you trade the way you trade. That's rare. And that's exactly the kind of trader who gets better. So if this video gave you something, a new perspective, a moment of recognition, a tool you can actually use, do one thing for me. Leave a comment below and tell me which of the 6 faces is yours. Which pattern do you recognize most clearly in your own trading? Because that awareness, that moment of seeing yourself in the mirror, that is where the change begins. And subscribe if you want more of this. No hype, no shortcuts, no strategies that promise overnight results. Just the psychology, just the truth, just the deep, honest work of becoming the trader you're capable of being. The pattern doesn't have to keep winning. You do.